We're half an hour away from the open in Hong Kong, Shenzhen, Shanghai. You're watching The China Show. I'm Annabelle Droulers with David Ingles.
Let's get to your top stories today. President Trump reiterates his threat to slap 10% tariffs on all Chinese goods, even as Beijing pledges to expand its imports to promote balanced trade.
The dollar strengthening on Trump's tariff talk, while Asian stocks, including SoftBank, rise on his administration's $500 billion AI investment plan.
And also ahead here on The China Show, the president says he's open to Elon Musk or Oracle's Larry Ellison to buy TikTok. YouTube star Mr. Beast is also joining a bid for the social video app.
Plus, banks, including UBS, said to have stopped accepting securities of Hong Kong developer New World as collateral for margin loans on growing concerns about its financial health. Taking a look at the market action, and we're really being led this morning by what's happening over in Washington, and essentially President Trump overnight spelling out these ideas for an AI investment theme or fund or vehicle, essentially $500 billion going into building out infrastructure, also trying to ensure that the US doesn't cede any sort of advantage in this space to China as well. So that's really a partnership between SoftBank, Oracle, OpenAI, and today, actually in the session so far, it is SoftBank that is leading the gauge high. So you've seen the broader one here up 0.6%, but the Nikkei 1.3% in the green, and also those other tech beneficiaries for AI, Taiwan, for instance, just coming online, 1.2% to the upside as well. So that is really sort of the broad overarching theme coming through. Of course, yesterday also was that story around China being spared for now from tariffs. We were talking about Mexico, Canada being first up from February 1. But again, just this morning, we've sort of had these news coming through. Trump reiterating this pledge that he is considering an additional 10% tariff if China doesn't do more to curb the inflows of fentanyl into the US through the borders, Mexico and Canada as well. So we saw the Golden Dragon Index actually a little bit under pressure and closing 0.4% to the downside. But let's also take a look at what's happening for futures, because it's not just sort of the US-China relationship. There's also these broader geopolitical concerns at play. And after we had the vice president attending the inauguration, that's Han, of course, Han Zheng, we actually had Xi out as well in local media reporting that really touting those ties with Russia in a call between Presidents Vladimir Putin and Xi Jinping. So there's sort of a few different threads, Dave, that we're watching or listening to this morning.
Yeah, and it looks like, sorry, that one of that 3% drop on your boards there is catching my eye. It looks like this tech rally might hit a speed bump today. We've been pushing towards the higher end of this, the 3-month trading range, and the pricing on that futures contract doesn't look promising, to be completely honest with you. 3% down in that, 2,000 on the other contract here. A couple of stocks that we're tracking going into today. So we talked about New World Development stocks, and particularly bonds, of course, on the back of conversations around financial health of the company. Within the stock equity market itself, so you have New Oriental at 20+% drop overnight. CATL, a lot of that is down to earnings. Certainly some guidance coming through on the full year numbers coming through from these Chinese companies as well. Iron ore and Dalian is one we're still keeping an eye on. We have a CGB sale today, 10-year bonds. We should get more details on that in about, I would say, 2.5 hours from now, so stay tuned for that. Now, apart from that, as Belle was just pointing out there, we're getting I don't know, this is a question mark. Do we have a better sense of how to trade the Chinese currency? Certainly, I think what the last 24 hours has showed us is that there has been a softer than expected tone so far coming out of the White House. It's provided a sort of window to unwind some of the extreme trades. But as the likes of OCBC have underscored, this one will remain sideways at best. Binary is the risk, and some of the other, the tentative relief coming through for Chinese assets is one of the things that Malayan banking has been underscoring as well. So we'll see how this plays out today. We are on a 6-7 day rally in equity markets, and it doesn't look like we'll see that in the opening minutes today on the back of, I guess, Bell. Just we're literally trading on every headline and on every word he says.
Yeah, but also at the same time, as our Bloomberg economics team will be pointing out, and I think as well Steve was saying yesterday, really a lot of China's issues, they're more homegrown than thinking about what Trump is saying as well. But irrespective of that, he still is driving the sentiment. And overnight as well, President Trump, as we said, reviving his threat of a 10% tariff on Chinese imports in retaliation for the global flow of fentanyl. Our Chief North Asia correspondent, Stephen Engel, and our Bloomberg News Desk editor, Jill Deesis, is with us now. So, Steve, I just teased your presence in studio, but kick us off with the latest on these tariffs and also how TikTok is possibly playing into that as well.
Yeah, at least in the first couple of days, we are sort of slave to the impromptu press conferences that he's held yesterday and today, where reporters can just pretty much throw any question at him, and we get the headlines. Going into this morning, we thought, okay, this is a pretty warm start to Trump-China relations. He basically gave a reprieve on the 60% threat of tariffs on trade. But again, now in this press conference, he brought up this 10% tariff, which we knew about. He had threatened that as well when he talked about 25% tariffs on Mexico and Canada to stem illegal border crossings as well as fentanyl across the borders. This time he's saying, well, we might just do that 10% on China to curb the fentanyl trade across both borders. So again, does this sour the mood? Not necessarily. I still think it's a fairly warm and conciliatory beginning, but that doesn't mean the bigger tariff package is off the front burner. It is still very much there, and it's going to see the agencies, the new agencies of Donald Trump, essentially do reviews on the efficacy of such tariffs, as well as the efficacy and the compliance of China of Phase 1 trade deal that he signed in his first term. We're also seeing some conciliatory remarks coming from the China side as well. We had Ding Yuexing, vice premier. He's speaking at Davos, saying China will expand its imports. Just hours, of course, after that Trump inauguration, he is saying that China is not looking at maintaining a trade surplus. So there were some kind comments, even though he did condemn the prospect of protectionism and a trade war. And now, again, there's a lot to chew on this morning. The TikTok story has taken another page. Essentially, in that press conference, he was saying that, and I think he even turned to Larry Ellison of Oracle there and saying, let's make a public deal right here before the cameras. He's open to Elon Musk and Larry Ellison, potentially others, going into a joint venture with the U.S. government to buy TikTok, a semi-nationalization, if you will. We haven't necessarily asked what China thinks about that. ByteDance in Beijing is against a sale, but the law says it has to be sold. Let's hear from Donald Trump. Why not?
Are you open to Elon buying TikTok?
I would be if he wanted to buy it, yeah.
On your inauguration.
I'd like Larry to buy it, too. I have the right to make a deal. So the deal I'm thinking about, Larry, let's negotiate in front of the media. The deal, I think, is this, and I've met with owners of TikTok, the big owners. It's worthless if it doesn't get a permit.
Now, again, we still do not know if he can legally, one, extend the deadline, two, have a joint venture and have the government also buy a stake in this, and whether China is willing to sell or let it go dark. There's still a lot more mileage to go on this story. One last thing about the more conciliatory tone from both sides between China and the United States is Marco Rubio, who has now been sworn in as the Secretary of State. He has been sanctioned twice by Beijing for his comments about the crackdown in Hong Kong and in Xinjiang and for pushing laws to punish Beijing. But Ministry of Foreign Affairs spokesperson yesterday saying Beijing believes it's necessary for high-level officials of both countries to maintain contact in an appropriate manner. They're saying they're willing to work with Marco Rubio.
Jill, let me bring you in this multi-faceted story on Trump and these impromptu press briefings as well. I think we were looking at this as being an AI one. Why don't you tell us about the AI angle to this?
Yeah, well, I think just in addition to Trump obviously loving to make deals, he also just loves big numbers, right? So what we also got out of this conference was this announcement that there's been a big AI deal, investment deal. SoftBank, OpenAI, Oracle Corp are sort of forming this $100 billion joint venture to fund AI investments in the United States. They're looking at potentially this JV would deploy at least $500 billion in AI projects over quite a longer time scale, with some investment potentially from Microsoft and also NVIDIA. It does seem like this kind of traces back. We know that Trump has obviously been courting a lot of big Silicon Valley titans over the last several months as he's built his campaign and ultimately won the presidency. We saw a few of those guys appear, for these tech leaders kind of appear not just at his inauguration, but also at various press conferences, including Masayoshi-san from SoftBank, who kind of hinted at this idea of a $100 billion investment just a few weeks ago. So I think, this seems to be the sort of fruition of that. What it kind of indicates, I think, to me, is that it's a pretty stark contrast with what we saw during the Biden administration, right? During the Biden administration, you saw a lot more caution, this idea of bringing in maybe some regulatory efforts to control AI. Trump seems to be going in a pretty drastically different direction. He's keeping some of the plans in place from the Biden administration, but ultimately wants to kind of smooth the way for private investment in artificial intelligence, potentially with the goal of competing with China in this space. So I think it is a pretty, different approach here that you're seeing from this incoming Trump administration.
Yeah, and just on that, I mean, I think if you were to talk to a lot of different people within the industry, they'd say that, the US does have a lead of sorts, but that lead is in no way guaranteed even to last over this year. So this emphasis on deregulation, I guess, goes into that effort.
Totally, Val. And I think that the other thing here, too, is that you've got advisors from the Trump side, including, obviously, Elon Musk, who, potentially are sort of speaking in the president's ear about this kind of thing, about this idea that deregulation kind of leads to some of these bigger, projects. I think you're definitely seeing a pattern here. And I think the other really interesting thing to kind of keep in mind is that you're also seeing a split with the United States versus the European Union, for example, which of course is more historically been over the past several years a lot more sort of cautious about sort of the digital space in general, technology, that kind of thing. You're seeing Europe I think be a little bit more cautious with AI restrictions and regulations now. Obviously under Trump, the U.S. is taking a very different tack.
Team, thank you. Stephen Engel, our Chief North Asia correspondent, and here, as well as Jill Deesis, of course, our news desk editor here. Right, I think long story short, across these markets are still loving what they hear and see here. We're up a fifth straight day, particularly on the chip stock space here, so lots to watch here. Go.
Yeah, that's right. And of course, part of this is also, just as Steve was saying, there's seemingly a little bit warmer start to the relationship between Washington and Beijing, and we're going to have more on those ties coming up. Former PBOC Deputy Governor Min Ju tells us there's still room for cooperation. We'll have our exclusive from Davos later this hour, and we're counting down, of course, to the open of trade in Shanghai, Shenzhen, Hong Kong. Futures have been pointing toward a drop. We'll see, of course, if that extends into the open today. Earnings also on the horizon in China, so we're getting some prelim figures as well. But more ahead. This is the China Show.
I think one thing to flag here is that I think at the moment, the equity market is not too concerned about U.S.-China tensions at the moment. And the reason I'm saying this is that we have a proprietary indicator to help us quantify to what extent U.S.-China tensions are embedded in prevailing equity valuations. And right now, I think we're at mid-range.
Yeah, that was Kindra Lau, of course, who we had on shows yesterday to talking us through really what their proprietary model is telling them what matters most for Chinese markets. Domestic issues obviously are still front and center, although of course on top of that you have this risk premium of geopolitics on top of that. Reference rate of the day's out, 7.17, splitting the difference here is your midpoint for the day. Let's talk through the outlook and what this means for the next couple of months for Chinese equity markets. Louisa is here with us on set, China equity strategist at Bank of Singapore. Good morning.
Good morning. Yeah.
I want to start with Trump. Why don't I start with Trump? It's softer than expected tone coming out of the White House. Granted, it's the first 2 days. What do you think is the initial prognosis for Chinese markets, given what we've seen so far?
I think the market has started with a more cautious stance and expected that there will be numerous executive orders being issued, including those related to tariff targeting China. But it I believe is what I would interpret it is marginal positive in the sense that tariff is still a focus, but it's probably delayed. It will not go away. Secondly, I believe the market take positively of one of the U.S. Social media. There's a 75 days grace period for further negotiations, and there seems to be a further dialogue between the two policy leaders, i.e. both President Trump and President Xi. So it soothed the market concerns a bit. But I do believe that the tariff will stay at the center stage for negotiations. We do expect that it still will be announced during first quarter. Implementation, that could be by stages. I think lessons learned from Trump 1.0 is that it could be a lengthy negotiation phases, and there could still be periods of trade truce or renegotiations or until the deal settle. So I would say it will start marginally positive, but tariff concern is still here. Yeah.
Does that still sort of remain a primary driver of sentiment, do you think, for investors, particularly from abroad, or do you think it still keeps with the domestic issues that are, clearly on the agenda as well?
I believe it's a tug of war between the both. I think since the President Trump was elected in fourth quarter last year, the market has already started pricing in some of the tariff concerns. This is one of the major issues during the president election campaign. So back then, market has already started building in the expectations. And then at the same time, we have the policy pivot in September. And we all know that we will have to wait until March, which is the National People's Congress, that we can get most of the qualitative targets, that including the GDP growth or some of the more focused one. For instance, what would be the headline fiscal deficit would be like. Last year was 3%. Currently, I believe the market consensus is looking at 4%. And if we delve into the details, that would be including what would be the incremental government bond issues that would be like. Last year was roughly about 11 trillion. I think right now the market is looking more probably towards an incremental 2 trillion, that sort of range. And this will give more quantitative guidance to what extent that all these policy pivot supportive measures, like, how to quantify it, that's the market has been looking towards.
Yeah, and I'm just looking at, the sort of, let's call it a calendar for the stock market here, right? So we have the 2 sessions in March. We possibly have incremental tariffs being put in place, over the next few months or so. It's almost as if I look ahead and there's always something that keeps the markets almost hostage to being range bound. And I wonder, how do you trade this?
So that's why in the first quarter, we've been suggesting taking a more defensive bias, simply like the calendar that you have highlighted. That seems to be a policy vacuum. We're going to Chinese New Year, and the mainland stock market will be on trading holiday all the way till February. And then in February, we may get some initial signs of tariff details that probably whether targeting China or with other countries as well. And then it will be until March. So there will be a period of what we so-called policy vacuum. Some of the policies that we expected has, unflowed and announced, for instance, like the consumer goods trading program. We and the market has been expected that it will be extended. Right. It's been confirmed. I think the size and scale that will be upsized. Last year was 150 billion. Right now, it's definitely have the capacity to go a double. But whether it will be exceeding that, we won't get this number probably later, around in March, that the timetable. So there's a period of what I've reiterated, that the policy vacuum. So a defensive approach, looking for some of the high defensive yield and also counters that are focusing on shareholders' value. That will be good positions to weather all these uncertainties during first quarter.
All right, Louisa, stay with us. We're going to have more with Louisa Fogg, China equity strategist at the Bank of Singapore, just as we count down to the open of markets. And actually, Hang Seng just coming online this morning. We're pointing toward a drop here, Dave. So we've just come off 6 straight days of gains. But, you know, we did see the Golden Dragon Index, for instance, a little bit under pressure overnight. We had some earnings out that really didn't set a good scene either. We had the education company, for instance, New Oriental, I believe, one of the names to watch. But we're going to have more details on that. This is Bloomberg. All right, coming into 6 minutes away now from the open, and one of the names that we're going to be tracking very closely, because in pre-market it's already down 15% at this point. But New Oriental Education, we had their ADRs being cut by Morgan Stanley, JP Morgan, Macquarie as well. What is behind that is, well, partially could be behind that is we had the earnings out from the company. Actually, for the second quarter, the numbers were good, but the third quarter forecast,
the guidance
is what's really spooked investors, because they're looking at net revenue of between $1.01 to $1.03 billion. The estimate had been for 1.32.
Well, that's why you don't become a public company, right? You're at the mercy of these quarterly...
the one reason against it, is that right?
Yes. I'm speaking out loud now. We're down 15%, as Belle was pointing out. Right, so, I mean, going into that as well, and I think you're also getting the sort of reaction coming out of the sell side right now. On the back of that as well. Online gaming is, can we have a look at that, please, if we haven't just yet? Not this, the next one. Online gaming. We talked about the 15% drop already. So I think 123 domestic games, 13 were approved, imported in January. So one was actually a NetEase game. Tencent, by the way, just to mention that as well. So while the market has actually rallied, Tencent hasn't quite recovered, recouped all the losses from the drop that we had last week following that inclusion into the Pentagon list as well. So I think just to highlight, just to juxtapose really a market that's rallied and some of the laggards so far on the back as well. You're looking at chips as well. No.
This is an interesting story. So it's actually, we're going to go to the FT now, because I've just had this story dropping about ByteDance. This is, of course, the parent company of TikTok and Douyin and others. But this is the focus here about their spending on AI chips in China this year. So they're looking to spend more than $12 billion on AI chips in 2025. That's right. You can see it there. They had budgeted around $5.5 billion to acquire AI chips in China this year, but it seems like they've upsized that. And this is going to be, of course, a beneficiary to names like SMIC, Huahong as well, those domestic players. But tech generally, and this isn't really a China tech story, but tech generally was the big leader in the session. And today we're seeing that huge gain in SoftBank, for instance, after the announcement from Trump.
I mean, the biggest point contributor to the MSCI Asia Pacific, I think, today so far, 8-9% over in Tokyo as well. And might that bode well for these Chinese equity markets on the Hang Seng Tech Index, by the way. So we are lower in the opening goings, but as you can see here in our chart, we've been testing and flirting with the high end of the recent range. Do we break above that by today? We'll see. The open is next. This is the China Show.
Welcome back. You're watching the China Show. We're counting down to the start of trade this morning, and we have been really moving higher for Hong Kong stocks, at least over the past several sessions. Today, though, we're actually setting up looking to losses of around 0.5%. We have, of course, kicked off Donald Trump back in the White House. The tone seems to be maybe a little bit more conciliatory than many would have anticipated. But, I mean, it's, as you were saying, we're really...
Who knows?
2 days in, not even.
The note out of OCBC caught my eye among the many things that have dropped in our inboxes from the sell side. It's certainly there is a temporary window of opportunity there, but the risks are even more binary right now, given that first you have these impromptu press briefings, but so far, to be also clear, there hasn't been anything new on the tariff front on China that we have to sink our teeth into right now. And certainly there are other things as well. I think what also helps is, and to highlight the other point, that from the Chinese side, and you look at the comments coming out of the foreign ministry briefing yesterday, particularly on Marco Rubio, for example, has really been almost an outreach here, the softer tone between both. So hopefully that lasts. We'll see how long it does. 0.3% to the downside here on the CSI 300. We have a 10-year bond auction today. Yield currently at call it 165 right now. Flip the boards, please. Hong Kong is what we're focusing on as well, and we're opening lower, just a little bit above, if not. Okay, I was expecting it to fall below 20,000. Not just yet, and hopefully it does not. Tech stocks, as we point out, the Hang Seng Tech Index should now be pulling back from the upper end of the trading range. And a couple of stocks that we're tracking here. So you have New Oriental was down about 15% in your pre-market. Disappointing on guidance, and JP Morgan, among other analysts that have come out and slashed their outlook for the stock. It's now down 30%. There we go. In the opening minutes. CATL is also a prelim earnings story, and the guidance coming out of the company is as much as 20% as far as the profit growth was concerned. New World is perhaps more a bond story. In the equity markets, though, as you can see, we're seeing some downside there. This is a story we'll unpack later on. Really, some of the debt covenants and some of the banks now looking to, I guess in many ways, step back a little bit their exposure. Anyway, more on that later. And Will Semi, of course, is also an earnings story. In fact, substantial earnings upside seen from the company. There we go, triple digits, 504% coming through. Okay, what else to mention here? Okay, this story just dropping. Let me just mention this too, ahead of the busy Lunar New Year travel period. Greater Bay Airlines has canceled more than 100 flights for next month, Bell, and March on the scheduling blunder. So we're looking at 128 cancellation, will be affecting 5,500 passengers. It won't, but the busy travel period coming up next week will not be affected. I think that's also important to note.
Yeah, it's also interesting when they also mention that they're operating all Boeing fleet at this point, and part of it was also the delay of new planes. And actually, on that Boeing story, there was also a Saudi airline, Riyadh Air, that was supposed to be beginning operations in the first quarter of this year, and they've actually had to delay the start of flights as well. So it's certainly having ripple effects, the challenges that's facing Boeing. But we're certainly digressing here at the open of markets for China. Still with us is Louisa Fogg, China equity strategist at Bank of Singapore. And Louisa, we were just speaking there in the ad break about the trips that you've done recently. You've been meeting with different companies and investors in China, but what's sort of the top question or theme that is coming up and again?
I think, first of all, from investor, it's still the same since the policy pivot. What would be the policy size, scale, and delivery? I think one thing from the monetary side, we get a top-down guidance that is going to be moderately loose. So rate cuts, reserve requirement rate cuts, these are all being expected. I think the biggest wild card is the size of fiscal stimulus. Like what I've mentioned, consumer goods that confirm, size and scale to be confirmed. But what else that will be? Another big question will be the real estate, the destocking effort that the central government has been endorsed. So far, the progress has been a little bit slow. I think that a little bit more needs to be done, because when we look at the real estate market on a nationwide basis, the number of months in terms of inventory is still close to around 30 months. If you look at the historical average over the past 2 decades, average will be about 25 months. So that seems to be that still a little bit needs to be done. Bear in mind that Chinese household has more than 60% of their household asset tied to real estate. So stabilization of the real estate market is important because it will help to unleash some of the domestic demands that has been stored up at the household level.
So while we wait for that, it might take a year or longer for that to sort itself. Do I stay away from consumer names? How do I how do I not miss any sort of 20% rally here and there?
I will actually look at it from two approaches.
Sure.
First of all is the policy beneficiaries, because that's very clear-cut. What are the product categories that will get the subsidies? Home appliances, and they also broaden some of the product categories from 8 to 12 as well. So that's a very direct go into details of specific. For instance, home appliance is a subsector that we like since the policy pivot last year. We continue to like it as well. The other way to play is from the top-down perspective. As we get all the top high-frequency data, for instance, retail sales, online retail sales, I think one of the easy way that to position is all these big internet and platform plays, because they have their sizable exposure in terms of e-commerce, in terms of advertising. We know e-commerce competition is keen, but I think advertising is also a proxy play to Chinese consumption. So I will see that they are probably one of the top-down sectors to go to if I see any consumption recovery signs. Yeah.
Is there a concern from investors about the ability for policymakers to follow through on these pledges? We know they've been saying for a period now that they've got cards up their sleeve. They're going to be able to push back on Trump tariff risks, maybe tariffs that come from other regions as well. But, our Bloomberg economics team has an interesting story out this morning, and there's also hearing from people that are sort of questioning, for instance, the resolve of the PBOC to implement looser monetary settings when they're clearly pushing back on the bond rally and the currency weakness.
There's always constraining factors to consider, like, for instance, what you've mentioned, the bond market, and also from the bank side, the net interest margin. One of the things that help the banks is also the cuts in the deposit rates, but there's, to a certain extent, a limited extent that can be done. But I think one of the major issues to look at is still credit demand. Monetary policy that has been implemented for more than a year or maybe more than 2 years in terms of rate cuts, reserve requirement rate cuts. I think it's right now is more the fiscal policy to take a step back, i.e. to stimulate consumption. Even small things like the recent increase in civil servants' pay. In terms of the absolute amount, it's not particularly exciting, but it will help from a sentiment perspective. And it could support some of the small amount consumption, like dining or online shopping for some of the value for money items. There are definitely leading players that could potentially benefit from that as well.
What is, as a final question, I guess, I don't know how to phrase this properly. Let me put it simply. How would you describe appetite for Chinese exposure among wealthy Chinese clients?
Among wealthy Chinese clients? Put it this way, I would like to take it from a broader perspective. First of all, from global investor perspective, we all know that MSCI China is still underweight among most of the global long-only or even hedge funds. So that will tell you, from an appetite perspective. Secondly, the strong U.S. dollar that we've seen definitely has drawn a lot of liquidity to U.S. dollar asset. And I think in general, emerging market assets, it's also negatively correlated to U.S. dollar strength as well. So I think that's definitely some of the liquidity being drawn to that. And lastly, from a structural themes perspective, AI is still a theme that we like as one of the 5 super trends. And we all know that one of the major dominant player or driving force probably will be rest in the U.S. from an AI perspective. Don't get me wrong, we still have some place in China from applications, from infrastructure perspective. But I would say majority of those are probably more related in the U.S. Yeah.
Louisa, fantastic. Thank you so much for joining us today there, China equity strategist at Bank of Singapore. It's almost like Louisa read our minds and looking at what is coming up here on our next segment, in fact, right now. So BoFA actually just put out their global fund manager survey. And guess what? The most crowded trades were, based on that survey,
Well, I think we can guess. But
Yeah, there we go. To Louisa's point just now.
Yeah, it's still dollar, still stocks.
Mag 7.
Yeah, still that AI theme staying intact. I think also what stood out to me about this was the inflation expectations as well, because what's risen is the no landing probability. There's still the base case for a soft landing, but the no landing probability has risen to nearly 40% of survey respondents. So
yeah, that's bullish.
Definitely sort of puts that question around what's the Fed going to be doing next as well. And, 80% of investors are expecting the Fed to cut rates in this year, but 2% are still saying they could hike.
And here's the complication there, right? So that's largely dollar positive. The most bullish catalyst based on the survey is a pickup in Chinese growth, which actually, if you think about it, hastens that no landing scenario out of the U.S. If a China that does well is inflationary for the rest of the world. Think about that for a moment. Anyway, speaking of...
Well, yeah. Very nice segues today, Dave. Well, still on China and, of course, the risk facing their economy, President Trump has revived his threat of a 10% tariff on China after initially leaving it out of the list of countries that he's targeting. IMF Deputy Managing Director and former PBOC Deputy Governor Min Ju spoke exclusively to us in Davos about where he sees room for China and the US to work together.
The Chinese says you are not only listen to what the people say, but also what people do. I think is more important. Fundamentally, and there's a lot of mutual interests between the U.S. and China, and we can work together. I think the benefits is much, much bigger than we fight to each other, become one winner, one loser. We even don't know who will win, who will lose, right? So it's a clear equation there. So I think President Trump understands that. So I think it's good for U.S., good for China, good for the whole world. If we can looking for a chance to work together, I think it's great. There's many areas working together, right? The trade area is a big issue. Investments is the second big issue. And the drug issue, Tiffany issue is also very serious issues. And beyond those things, and we can working for the global public goods, and although President Trump don't mention that much, but as a leading economist in the world, it's all the area working together. So I think it's good. I think he understands the situations. He wants to see whether we can work together. That's good.
Is your view actually too optimistic? I mean, maybe it's not 60% tariffs, maybe it's 50, 40, and it's just a matter of when Trump imposes those tariffs.
Yeah, you never know, right? For Trump, the unpredictability is the key issues. We don't know, right? But I think the starting point is good, right? If he's looking for the cooperation with China sides, I think there's many things on the table we can talk about that. So that would be good. So we're moving that positive way, move forward, is to give the positive signs for everyone, right? So I think this is good enough already. We will see how things goes, right? For China, we experienced Trump 1.0. When Trump launches 3.0 against China, it's really out of the blue, right? We don't know. So it's a hurt trade. The China's export to U.S. the tariffs increased from 3.7% in average to today it's 20% now. It's pretty high, right? And capital market also in 2018 that year dropped quite a bit. We did a study found very much linked with the trade policy as well, right? And Chinese company start to move to third place. So it does have impact, but we learn a lot of things, trade diversification for China's, and the company also try to build a more resilient supply chains as those things. So I think in these days, we'll see how things goes.
We've been talking about how China is more prepared this time to respond to U.S. tariffs. What do you think are some of the tools China can tap for that? How do you see China responding should those tariffs come?
Yeah, I think the responding, the most important thing is to do our own thing better, the first. As Americans say in Texas, clean your own house, right? So the first things we do is we do the stimulus policies. Stabilize the market, boost the confidence. I think those are the most important things. Right, then stick on a few key issues. For example, emphasize on domestic consumer market, emphasize digitalized manufacturing and emphasize carbon neutrality transformation. So we want to make sure our strengths, the competitiveness is there. So I think that's the most important preparations for whatever things that happen, right? So it's not action, reaction. You don't want to get these visual cycles. It doesn't yield good things.
There we go. That was the IMF Deputy Managing Director and former PBOC Deputy Governor Zhu Min speaking exclusively, of course, with our colleague Heslin Amen in Davos. Plenty more ahead. This is Bloomberg.
UBS is the latest bank to stop accepting some bonds and shares of New World Development as collateral for margin loans. That's joining Citigroup and also HSBC. It comes after New World offered properties valued at $15 billion as collateral for loan refinancing. That was our scoop yesterday. Let's delve into this with Bloomberg finance reporter Denise Wee and also Patrick Wong from Bloomberg Intelligence. And Denise, we'll start with you. What exactly is the latest here? It seems like there's a host of banks here that are now getting quite nervous about ability to service loans. So
there are two things going on here. There's that margin lending curve, which is what the banks are doing with their wealthy clients. Basically, it's their risk. They're deciding that they don't really want to lend against the securities, New World securities. It doesn't really affect the company itself, but it's a barometer for risk, what they, the attitude towards risk of the company. The second thing that's going on is the refinancing risk, as you mentioned. So they've got loans coming up due, and they've approached the lenders to refinance those loans, pledging double the amount of that, about $15 billion, to refinance about $7.5 billion of loans. So I guess what's key is how the lenders will react here, and whether this refinancing will go through.
So when we look across signs of stress, is everything out in the open right now? What other signs of stress right now are we looking at as far as the company goes?
They've talked quite a lot about various things. Earlier this week, they denied that any holistic restructuring. They had that statement, yes. Yeah, they actually said that, came out and said that. Yeah. But there were rumors. This was a response to speculation in the market. Right. And I think last year they asked the banks to postpone some maturities on bilateral loans, and they've also had bonds falling this week. So there's been various signs of stress building in the bond prices. And that's obviously making lenders a bit more nervous.
So, Patrick, we know that New World is faring worse than its peers in the market. Is that also down to the shape of its footprint in property?
Yeah, I think we see the situation now is that for New World, because basically the Hong Kong or mainland China property market is also suffering quite a bit, right, in different aspects. And then for New World Development, this company, they did lots of different investment over the past couple of years, and the leverage ratio keep rising at this point, which almost like 100%. So that is getting really nervous for everyone at this point. And then we also figure out some analysis in terms of the leasing portfolio for New World versus the other Hong Kong developers. And we realized that for the assets in the balance sheet is either a bit overvalued, or the rental rates of those investment properties are really low versus the other property companies. So you see, and also the margin is not high at all, right, versus the other companies for the leasing portfolio in mainland China. So that means for New World, they have their own issues, right, own problem, right, versus the other developers.
Well, yeah, I was going to get into that as well. I think, just in case some of our viewers missed that, you just mentioned it earlier on. I'm wondering if you could just get into that a little bit more. What was the rumor that New World came out with a statement to quash, basically? Because I think that goes into the other thing I want to get into.
Well, I think it was around financial advisors or restructuring, something along those lines.
Right, somehow a wholesale restructuring of the company right now.
I think it was around debt
something along those lines, right. So Patrick, I guess the question there is New World now running out of options to manage its liquidity?
The challenge, I think, right now is that either they could sell some of their assets, right? Then they could basically get the liquidity, right? So there also talks about like they're selling the retail assets in Hong Kong in the past, right? But unfortunately, I think it didn't happen, right? They sell a little bit, right? Like the industrial properties, for example, but it's relatively small amount. And also the parent company also help in terms of the Kai Tak Sports Park, but that is also relatively small amount as well, right? So relatively, I think the concern right now is whether the other investor would buy some assets from them, or basically the parent company would support further.
What about this pledge of some of its commercial properties for loan refinancing? Would that be able to help? Just very quickly on that.
The one is challenging, right? Because they pledge some assets, then they can't sell easy, right?
Right.
And also depends on the valuation. It makes the situation more complicated.
Okay, team, thank you so much. Fantastic. Our team here, Patrick Wong from Bloomberg Intelligence, and of course, fantastic reporting from Denise there. Denise Wee, our finance reporter. Right, yeah, plenty more ahead. We'll have a look at these markets going into the thick of the Wednesday session. This is the China Show. Okay, glance at some of the big movers right now. So good news, by the way, out of Sunac, China, after this, an agreement with creditors, approval from the creditors specifically on this debt overhaul. And as you can see, the stock is reacting quite nicely. That is, of course, one of the sort of more encouraging and bright spots along that broader conversation of debt restructuring. We've been trying to figure out really how far and how deep the issues go with China Vanke, and certainly we've spent a lot of time talking about that as well. Currently, right now, shares are unchanged. Country Garden is a stock that has, if you're just joining us today, missed this yesterday, Country Garden has in fact resumed trade this week after being suspended since April of last year. We're down a further 9% on that. And we talked about New World and some of the earnings that have come through. Will Semi, 500% guidance coming through out of the company. Sujin's out with some guidance as well. Shenhua is out with some more information on its dividend. And CATL is down the most since October. That's also a guidance story coming out of the company.
Yeah, but actually 2024 numbers, again, they were good. They actually surged as much as 20%. But again, it's just those concerns about what they expect for the year ahead. More ahead. This is Bloomberg. Welcome back to the China Show. Taking a look at the HSI half an hour into the session, and we're actually just drifting lower so far, off 1.4%. What's leading that decline are the consumer discretionary names. So taking a look at some of the biggest mover, the likes of Meituan, Alibaba, JD.com, BYD, New Oriental Education. You know what? Every single one is in the red today. There's actually a lot of red in Hong Kong today, just generally.
Yeah, absolutely. And I think it's just exacerbated by some of the names that you just mentioned there, with New World down about 27% or so. And some of the big winners of the rally of late, really you can see investors taking some profits off the table. JD.com is down about 5% as well, really the tech space there. The story across Asia Pacific, though, is one that is largely positive, and we can really just draw almost a direct line between the benchmark moving up to some of the chip plays, which we'll get to in a moment here, plus the SoftBank story, which is a related AI play. So Nikkei's up 1.6%. Another AI play in the region is Taiwan, up 1.4%. S&P futures are continuing to climb. In fact, they've now taken out the 6,100 level there. We are in the thick entering earnings season. So if the last 5 reporting seasons have been any useful guide, this one is probably going to deliver quite substantially again. Right. The story across FX markets is one, of course, that has a massive geopolitical footprint on top of it, with, interestingly enough, gyrations in the US dollar. If you net things out over the last 7 days or so, it's really been 7 days of gains for EMFX currencies. That includes the Mexican peso, the Chinese currency. And a lot of that might have to do with the fact that so far we've yet to really see a hardened stance from the White House as it pertains to China. Maybe just yet. So it's first Canada and other things as well. To the other point we were making earlier on, The AI initiative out of the White House is really leading to gains in SoftBank, now up 9% on the stock. TSMC and other chip plays in the region, as you can see on your screens there, on the way up. And it's really hard to argue against, Bell, the BoFA survey
I think
came
that
out.
sort of underscores it as well, because they've obviously been polling their different fund managers, and the most crowded trades are the Magnificent Seven, also dollar and equities generally. Bearish on a lot of other things, though.
Well, everything else.
Yeah.
Except the US dollar. Something that could change that, though, is China. And again, we're waiting for the catalyst. What could change the math across most strategies out there if China improves? That's a big if, and certainly a question of when as well. Right. Let's get the market context and take right now where we are with Mary Nicola, our MLive strategist. Mary, it feels like we've been here for years. We're at day 2 of this new White House story. What's top of mind for you today?
Yeah, I think it's more about just synthesizing some of the news that's been coming out in terms of, is Trump taking a softer approach towards China, which would be a very welcome reprieve, and that's what we're seeing across currencies in general, in terms of saying that there's a softer side to China. Even at 10%, it's a lot less harsh and punitive than what he had suggested earlier of 60%. So there's still there's a hope. I guess you would say that they could be taking a softer stance, but it's still too early to tell, because I think in general during the campaign trail he was talking about a 10% tariff to start and then potentially increasing to 60%. You still have a study going on, and as we saw before, when he first came to office in 2017 and he commenced his first term, he made a few mentions on executive orders. He started a study, and a lot of the tariffs were not implemented until 2018. So there's still some time there. So it's hard to get too sanguine about the outlook, especially when his cabinet is just filled with a lot of hawks, a lot of China hawks.
Yeah, in some ways it also seems like, in the early goings, things are being crystallized to an extent as well, and sort of the trading themes that we had last year, geopolitical tensions between the US and China, they aren't going away. But the AI theme very much seems to be intact, and now we're getting, of course, this major new investment. Does that really bode well then for the outlook for Taiwan, for instance, this year?
Yeah, of course. So I think a lot of the tailwinds that you'll get, especially from U.S. equities and the focus on AI, because that seems to continue to resonate with the Trump administration. That's a key positive for Taiwan, and I think it'll continue to do so. And then, of course, it's just Taiwan. What we see with TSMC ends up being just subject to what we're going to see from NVIDIA. So as long as NVIDIA does well, we'll see TSMC doing well at the same time. But of course, the AI story, if you're looking at long terms and productivity, the focus on improving productivity, that's not going away. So any AI related stocks are likely continue to do well. And then, based on the Bank of America manager survey, if you look at equities, especially U.S. equities, are still top of mind for a lot of investors. And that too makes a lot of sense in terms of just how investors are looking at potential deregulation in the U.S. And of course, if we look at the potential growth in the U.S. versus the rest of the world, it still leans heavily to support the U.S. and to U.S. equities. Mary,
clearly a lot of other stories have taken a back seat given all the political headlines this week. What do you think we're ignoring? What's important that's missing in conversations these days?
Yeah, I think Bank of Japan is one of the key things that is missing, and we were obsessed for quite some time about your fiscal deficits, and that's also completely taken a back seat. But let's start with the Bank of Japan. We have the decision on Friday. The market is almost fully pricing in a hike from the Bank of Japan. So the yen just needs a little bit more from the Bank of Japan in terms of they need to suggest that there's going to be more hikes coming their way, or some sort of increase in terms of quantitative tightening from that end to just help the yen, because you could arguably say that a lot of it has been already priced in. So it just needs an additional jolt. And of course, we're seeing that precipitous decline in U.S. Treasury yields, and that's also been a boon for the Japanese yen, but it'll still need something from the BOJ. And then, of course, if we take to the budget deficits, we've not heard much yet on fiscal spending from the U.S. That's taken a back seat. That's helped yields, and of course, we don't see any major focus on the tariffs just yet. So that also takes some pressure off inflation, and of course that we have the oil prices coming off. So inflationary pressures and expectations are easing on the back of the decline in oil prices and the fact that tariffs don't seem as punitive, but still, we still have that fiscal policy wild card still looming, and we still don't know where the direction of the Trump administration is going, and that could obviously reprise a spike in yields.
That was Bloomberg's Mary Nicola there, and of course the direction of travel, not least for how the relation shapes up between Beijing and Washington as well. And as we were mentioning, President Trump has revived his threat of a 10% tariff on Chinese imports in retaliation for the global flow of fentanyl. Our Chief North Asia correspondent Stephen Engel and Bloomberg's Chief Asia economist Chang Shu join us now. And Steve, we'll kick off with you on this tariff. Of course, It's something that we've already heard before.
Sure.
In a way, is that a positive then, because it's not something that's a fresh levy?
Yeah, I liken it to yesterday. China basically dodged the artillery, right? The bombs were coming in potentially, and they dodged it, only to be hit by a stray bullet today. And that stray little bullet was this reviving. Oh, yes, because it was in an impromptu press conference, right, where they asked about tariffs. Yes, they sidestepped the broader tariffs upwards of 60%. That's still potentially in the works, obviously. He's tariff man, Trump, right? So he's going to probably do it. He's entrusted his agencies to come up with studies on the efficacy of global tariffs, including on China, as well as to kind of see the compliance of China from the phase one trade deal. So that was sidestepped. They missed that barrage. But today he was asked about it again, about tariffs, and he said, well, 10% is still in the cards, possibly February 1st. And that is not necessarily the broader one, but it is on broader goods. But it's because, as you mentioned, the fentanyl issue and the border. And it is something China could address. They don't necessarily have to completely cut off fentanyl precursors in China and then the shipments. And it's a complicated supply chain, if you will. And that's something that China's also sort of said, we'll help. Remember, Biden and Xi did meet. They talked about it in San Francisco without admitting that they're doing this. But they can say the right things again. They could make some steps to avert this by February 1st. So I still think the overall tone is positive in the opening 2 days between Trump and China relations. It was also in evidence by the vice premier was speaking in Davos, and he was like saying, look, we don't aim to have a trade surplus with anyone, and especially the United States. We are going to import more. And he was more conciliatory. Yes, he did warn about trade wars and protectionism and this and that. That's a common narrative from Beijing. But I think overall, they're trying to say the right thing in Beijing, including saying we're willing to work with the sanctioned Marco Rubio as the Secretary of State.
I'm glad you brought up the comments out of Ding Xuexiang that they're willing to buy more. And I think, Chang Shu, it's a perfect segue to bring you in. I mean, the Chinese have said and acknowledged the lack of domestic aggregate demand onshore. They can buy more, but can the economy actually afford to buy more goods that, frankly, they probably don't need at this point in time?
Yeah, it's very challenging, and the world and China certainly are watching out for what tariffs damage will be on China and the rest of the world. But China, as you put it, it has a lot of domestic concerns. I mean, on people's mind now is really how big the stimulus is going to be and how the government is going to do it. The sentiment is very fragile. We've been traveling and talking to different financial institutions and enterprises, and people are concerned. The government is certainly trying to signal quite positive, big stimulus to come, and is trying to put some measures in place. But still, people have really mixed feelings. Whether the policy stimulus is going to be as big as indicated, and what's the composition? Is it going to shift to consumption, right? Without consumption demands, and China is hardly in a position to buy more from overseas.
So, Steve, sort of now looking at how TikTok fits into this as well, I mean, that also is maybe sparking a bit of a sentiment shift or a reappreciation also of the relationship.
Yeah, TikTok is probably not China's priority right now, given all the concerns that Changshu just mentioned about the consumption levels in China, the deflation, the property sector. TikTok, sure, Beijing doesn't want to sell TikTok, doesn't want ByteDance to sell, but there's a law now from April that they have to sell. The bigger question is, can Donald Trump strike a deal legally and feasibly with some potential billionaire, whether it's Elon Musk or Larry Ellison that he suggested today? But the TikTok issue is sort of in the hands of the United States on how they can potentially read the letter of the law and implement it, and can they even do a joint venture where it's essentially nationalizing TikTok by the U.S. government going into a joint venture, Donald Trump going into a joint venture with Elon Musk or Larry Ellison or Kevin O'Leary or Frank McCourt or whomever else wants to pony up the big money. Beijing will resist until they can no longer resist the power of the U.S. law, and then they let it go dark.
Changshu, well, the tariff issue is probably not the biggest issue that Beijing has to face. If that goes away, most of the other things get easier to do domestically as well. Is there a case that maybe, do you see capacity for China to meet some of these obligations, some of these asks from Donald Trump in order for the tariff threat to go away?
Yeah, I think China was certainly likely to make best possible efforts to meet the demands. I mean, there are certain areas there could be purchases of agricultural products, some obvious area. China certainly will have to do, but in terms of the broader picture of meeting the demands, it remains quite challenging. Okay. Even if we talk about agriculture, China had shifted a bit away from over-reliance on U.S. agriculture products, but now it would mean a reversal. So it's not easy to strike a deal with the U.S.
Yeah, and it's not just tariff risk from the US as well. There's Europe, for instance. I'm sure it could end up coming up with the Global South as well, where China's looking to export a lot of these products. Talk to us about the challenge that they're also facing in terms of what's called involution, where the competition is so aggressive within the country that they actually need to have some sort of policy response to address it.
Yeah, indeed. I would say at this point the domestic challenges are even more severe than the fears coming from tariffs and coming from the Trump administration. We talked to a lot of enterprises. The word that's on everybody's mind is involution. I don't know whether the word fully captures the meaning in the Chinese phrase. It really means meaningless competition and really cutthroat competition. A lot of enterprises are thinking, because of the strong domestic competition, we have to go overseas, even in the environment of rising protectionism. But then, even before the start of this whole process, they are concerned about backlashes from different sources. It could be attracting greater concerns from other economies, US, Europe, or that just simply mean Chinese firms bringing domestic competition overseas, and that's another form of involution. So it's pretty challenging.
Yeah, and then it becomes political, doesn't it?
Yeah.
Right.
And also, it doesn't help with consumption. We know a lot of people are working extended hours, and especially for young people, and that's stopping people go out and have enjoyment, right? To spend. Yeah.
Fantastic. Thank you. Stephen Engel and Changshu here, of course, on set. Right. As we were talking there, we talked about Vanke. We've been talking about this stock and also the bond in the story here of late. That's the stock on your screens. That's not the story, though, today. So a couple of its local currency bonds have been halted. And by the way, the halt is it's a market mechanism, effectively, when you get a massive price surge like what we've gotten so far. So we're actually looking at, well, on my screens, at least 4 specific bonds. There's the one that's at 349. These are coupons, by the way. 349, 364, 353, and 37 after prices surged 20%. So, my expectation is these actually should be resuming trade after that window, of course, given by this market mechanism. Plenty more ahead. This is Bloomberg.
President Trump says he would be open to billionaire supporter Elon Musk or Oracle's chairman Larry Ellison buying TikTok as part of a joint venture with the US government. For more, let's bring in Bloomberg's tech reporter Newly Purnell. And, the speculation just continues every day, every hour. It seems there's a new thread to follow up on. But what's happening here?
Yeah, exactly. There was this interesting, sort of clip that we've seen of Trump speaking to reporters, and one of them says, "Mr. Trump, would you be open to Elon Musk buying TikTok?" And he said, "Yeah, if he wants to." And Larry Ellison, the founder of Oracle, was standing behind me, said, "In fact, Larry could buy TikTok. And Larry, should we start negotiating a deal in front of the media so they can see how it's done?" So sort of this humorous moment, but he did signal, President Trump, that he would be open to that. So 2 more potential names to add to the mix. And again, it's Trump as deal maker, art of the deal. He's also stressing, look, ByteDance, TikToks, they have to know that if we don't give them permission to operate in America, the thing is worth nothing. So it seems like some deal making happening here.
Other names that are being tossed around, James Stephen Donaldson. You guys know who that is? Mr. Beast, right. Actually, that's his real name. But yeah, talk to us about that and other options.
Yeah, so interesting character. He's the world's most followed and highest earning creator. I believe he has 347 million subscribers on YouTube. I think that's around or more than the population of America.
Yeah.
Sensation around the world. He's part of this new group of investors that has emerged, also including Employer.com founder Jesse Tinsley. And so they've said, we've submitted a bid where I believe they met with, or one of them with President Trump at Mar-a-Lago, and they're saying, we'd like to throw our hat into the ring. Again, it's easy to get caught up in this narrative of all these people coming out of the woodwork saying they're going to buy TikTok, but it's important to remember that ByteDance, TikTok, has never signaled that they'd really be open to selling. So keep that in mind as we see potentially even more names pop up. Of course, we've got, 73 more days until the executive order expires, so I expect we may see more of this. But interesting to see, it's not every day that a platform with 170 million users in the U.S. is threatened with going out of existence if it doesn't divest. So really interesting to see what other twists and turns might come.
Yeah, and what's sort of also a twist is that structure of the joint venture as well between the U.S. government and also private enterprise. I mean, that seems quite abnormal.
Yeah, and a lot of it's unclear. We had the ban coming into place, and then there was, the app was removed from Google and from Apple's App Store. And then there was a question of whether Oracle, to go back to Larry Ellison, would continue to support, because even if Trump is saying, well, I don't want anybody to enforce these rules, you also have the providers who are on the hook as well. So I think a lot of the legal and the financial details are pretty unclear at this point.
All right. That's our tech reporter there, Newly Purnell, on the latest with TikTok. And, of course, part of that very wide-ranging press conference yesterday with President Trump was him also saying that he planned to repeal a lot of different DEI or diversity and inclusion measures. this
at the federal government level.
At the federal government level. We're now understanding from Trump's press secretary, Carolyn Leavitt, she's posted on X about this, saying that from Wednesday, federal workers in DEI roles are going to be placed on paid leave. So that's the latest on that front. We'll have more details as they come to hand. This is Bloomberg.
Right, welcome back. Okay, a reminder that we are entering the result season in China, so we have a couple of names, of course, to tell you about later on. I mean, New Oriental is actually one that's really caught headlines today, but separately, though, Citi's out with a note here, and they've reduced some of their price targets on some property developers. These three specifically: China Overseas Land, Long4, and Shenzhen Investments are part of that as well. Effectively, the thinking is, and this is just a very long-winded way of saying it, the property market isn't doing as well. It's a very soft market, so Citi's just revising their views as far as the outlook goes. Speaking of property, Sunak is also one we're watching today, doing very well. In fact, last we checked, we're up 3.6%, and it managed to get the approval and the support of its creditors here on this debt overhaul, specifically on the $2 billion in negotiations here. Right, very quickly, energy stocks also in focus here. Oil, I believe, is on track for a weekly drop, and as you can see, that's really playing out across some of the energy plays in this market. I think we're down to successive days here on Brent and also in West Texas. Right, okay, we're going into the Japanese lunch break, where that is really one market that is doing very well amidst what is at best a mixed session across most of the region. As our colleague Mary Nicola had pointed out earlier on, do not sleep on the BOJ. That's the other big one, of course, later on this week.
It's 11:29 a.m. in Tokyo. Japanese markets are just about to go into their lunch break here. SoftBank is really the story that we're tracking because there's a major AI push that Trump announced overnight. It involves OpenAI, Oracle making major investments into AI infrastructure, in particular in the US. It all comes down to that competition between the US and China. A bit unclear whether these are sort of new commitments. We already knew that SoftBank was looking to invest $100 billion into the US, but still, this is definitely just a signal of the AI theme. It remains intact for probably at least another year, but SoftBank, they're up 9%.
I think with scope to increase that even more over the next few years or so. And that's really leading to, I think, what is keeping, or only one of the few markets that it's keeping the benchmark on seeing some green right now. So Nikkei's up 1.5%. In fact, on that very point, when you flip the boards, it's mixed at best. You do have Taiwan, of course, doing its role. But as you can see, Asia's up 0.25%. And a sizable move in U.S. futures right now, 6,100. Going into the Wednesday session, mix across some of your sector boards as well. Right, so that's the market story for now. Let's pivot now from markets to luxury and get into, of course, the thick of things here.
Yes. Yes. All right. We've got a new report actually out from Bain & Company saying China's luxury sales plunged by as much as 20% last year, bringing the market back to 2020 levels. The report says the fourth quarter showed only a slight improvement on the back of Beijing's stimulus promises. Wei Weixing is a partner at Bain and joins us now for more on this. So, I mean, is this sort of any surprise that we're seeing this slowdown? We had all the signals really all year coming through from different luxury names that things weren't looking too good in China.
Yes, exactly. So I think, before we talk about last year, we really got to put things into context, right? If you look at between 2018 and 2021, the market nearly tripled. That's astonishing growth. Of course, we know what happened in 2022. 2023 was a year of recovery, and then 2024 has really been the first year with real substantial decline. As you rightly pointed out, quarter over quarter, things sort of got a little bit progressively worse, with Q3 being really the worst of it. And then, of course, in Q4, with the stimulus announcements, we are starting to see signs of the market doing a little bit better.
Well, are there specific product categories that did certainly worse than others?
Yeah, I mean, first, all the categories were affected, but some fared better than others. So on the more positive side, beauty had a single-digit decline and did relatively well. And that's because, in sort of tough economic times, consumers are looking for these small luxury purchases, and they're looking for sensorial experiences. So as a result, fragrances and color and ultra-premium skincare has also done very well. But on the other spectrum, jewelry and watches have really taken the biggest hit. In a way, they are the ones that historically, compared to the other categories, have performed a little bit worse as well.
What else sort of stood out was also that a lot of the spending that is happening, because Asia Pacific didn't do too badly, and it's really one place, and that's Japan, and it's the weak yen. Do we need to sort of think about it doesn't really matter. It's agnostic to country. It's more about Chinese consumers, and they are still spending, but just maybe not in their home stores.
You're exactly right. Actually, when we think about sort of mainland China luxury consumption, we got to put it into the context of the Chinese cohort. During the COVID years, the border was closed, right? So the vast majority of luxury consumption happened within China. Actually, at the peak of it, 95% happened within China. Versus last year in 2024, we estimate about 40% actually happened abroad. So that is actually one of the key reasons why we're seeing the market take a hit as well. And as you rightly pointed out, the travel to Asia Pacific and luxury consumption to Asia Pacific has recovered to 120% of the 2019 level. So indeed, people are going to places like Japan, Southeast Asia to make their luxury purchases.
This might be anecdotal, but I'm wondering, are price levels in Japan, because of the exchange rate, actually cheaper? In other words, what is that arbitrage trade, if that makes sense?
It's very sizable. Okay. And for the consumers that are price sensitive, it is very attractive. We did a snippet, a spot check of different, popular products. Yep. And we saw price gaps as large as 30%.
Wow. Okay.
In different categories.
So how does that play then into grey market activity as well?
Yes. So gray market has always been there. They get a little bit bigger or smaller depending on the time. Of course, the price gap between Japan and China and other markets, they are contributing to the gray markets, but that tends to be individual or small scale daigous, as we call it. Yep. The real big sort of business-like scale daigous, we believe the sources of the products are actually coming from the wholesale channels in other places and not necessarily due to the currency fluctuations.
What about other places where traditionally you did see a lot of the luxury purchases, for example, Hong Kong? And if you could also compare, Europe is also a good example.
Yes, of course. So in Europe, we're seeing the level to have recovered to about 65%. That's compared to last year,
that's
about 40%. Okay. Yes, I mean, there are still, overall, people are definitely showing more of a preference to travel to Asia Pacific, somewhere nearby, as opposed to Europe. So that is affecting it. Hong Kong has been mixed, right? Hong Kong has been soft. The good news is we're seeing the tourists coming back. You very much see them on the street. But perhaps the profile of the tourists and their purchasing behaviors have evolved a bit since before 2019. They're more here for the experience, for maybe taking photos, and not necessarily translating completely into luxury purchases.
Yeah, I was actually going to ask you, how much of this is obviously economic in nature, and how much of that is just a shift in consumer behaviors, and how much of it is also generational too?
Yeah. I guess, some of it is the mix, the profile of tourists that are coming here are a little bit different. We're getting sort of the GBA ones that are coming in groups, and we're, of course, getting a lot of young people that are coming here, like I said, more for the experience, right, for the photos and so on and so forth. Yeah. So as a result, it really hasn't completely translated into purchases. Okay. We do have a segment of Chinese, affluent immigrants that are now living in Hong Kong. But what we see is many of those relationships with their sales associates are still in mainland China. So it will take some time before the effect of that is seen.
So what's your outlook then for this year? Do you see any sort of improvement? And which brands are standing out to you? I mean, a lot of people say Hermes, for instance, is better at withstanding it than a lot of others. But anything there to note?
Yeah, many of the brands did not do so well this last year, but you're absolutely right. There has been bright spots, right? And it's not necessarily the biggest brand. Scale is not really the only indicator, if you will. There were a few smaller brands because they truly have been able to create that connection with the consumer and have a very distinct value proposition. They've fared well as well. So, outlook for this year, I guess we're cautiously optimistic. We think 2025 will probably end flattish. First half will still be challenging. January was not great. But as the more stimulus come into play and to stimulate overall consumption, luxury will be no exception. So we believe second half will be a little bit better. So ending the year on a flattish note.
Yeah, a lot of the issues, to your point, right, are outside the control, really, of both consumers and sort of the companies themselves. Within the control of companies, what advice would you give right now to luxury names, for example? How do they engage with their clientele?
Absolutely. It's a time to go back to the fundamentals, right? If you think about what has driven growth in the last few years, it was really rapid store footprint expansion, price increases. Those things won't necessarily hold in this new era. Now it's going to be much more about coming back to the roots of the brand, right? What do you really stand for? Are you distinct? Do you have a clear point of view? And are you able to really offer the products and the assortment that fit the lifestyle and the desire of this new generation of consumers? So that will be the key. And we certainly believe there's still huge opportunities to be unlocked, and the brands that are able to do that will perform well.
Thank you so much for taking the time. Let's do this again, of course, and hopefully the next report will be slightly better than the takeaways from the current one, given the reality there. Wei Weixing, partner at Bain and Company. Right. Shares of Netflix, speaking of earnings season, jumped after the bell as it closed 2024 with its biggest quarterly subscriber gain in history. That's thanks to live sporting events and the return of Squid Game. Sohee Kim, our news reporter, is with us to talk us through the big takeaways out of this Netflix series. Let's put it that way. Sohee.
Netflix reported very strong earnings with a record 18.9 million new subscribers and 15% revenue growth. This is a massive one because it's a stronger earnings than the previous COVID period. The market cheered the results, sending the stock up more than 10% in after-hours trading. Netflix said its live streaming programming such as Tyson pole boxing match and Christmas Day NFL games helped boosting its subscriber number in the fourth quarter. And the return of Squid Game also played as a very key driver for the strong earnings. And as it has proved that both of sports live streaming and big franchise series can turbocharge its business growth, Netflix is going to raise subscription prices for premium and ad tier in the US and Canada and some other markets. With that, Netflix is very confident that it would post better earnings in coming months, and its biggest titles, Squid Game, Wednesday, Stranger Things, are all returning this year.
Just quickly, Sohee, what does this all mean then for Netflix's business in Asia?
Well, Netflix has been trying to expand its footprint across Asia for years now. It's a reason that poses both opportunities and hurdles. So over the past few years, the company has seen strong growth in markets like India, Japan, and South Korea. But competition has been very fierce and local preferences are pretty diverse here. But obviously, South Korea has been the key and very biggest content production base in Asia, thanks to the global success of Korean dramas like Squid Game and Survivor shows like Culinary Quest Wars. But at the same time, it has been diversifying contents late in Asia with big focus on Japanese anime titles and India's South India content titles, the two big and fast-growing markets for Netflix.
That was our Bloomberg news reporter Sohee Kim there, and we'll have plenty more ahead. This is Bloomberg. We're taking you to the big mover in the Asian session today, and that is well and truly SoftBank. We've seen shares jumping in Tokyo into their lunch break now, but President Trump announced a multi-billion-dollar push by the Japanese company, also OpenAI, Oracle as well, to build an AI infrastructure or build out AI infrastructure in the US. The initiative, which is dubbed Stargate, aims to speed up the development of AI technology and fuel US economic growth. Let's get more on this now with our Bloomberg Intelligence senior analyst, Robert Lee. And Robert, we were just talking there, this is sort of the broader implication now around the AI theme, and it definitely seems like it's still going to be an investor favourite for this year.
Yeah, I'm afraid so. We're going to talk, I guess, quite a lot about it again this year. I mean, this is obviously a massive boost of confidence. I mean, perfect timing, obviously, with the new president's inauguration. So, that boost of confidence for both the AI sector in the States and also for the related infrastructure providers, some of which, as you're aware, are in this part of the world, particularly the TSMCs of this world. So, again, I think, you know, the companies that are really profiting from this are the obvious hardware providers. I still think there is the ongoing question about how these software companies will monetize ultimately. But maybe we can come on to that in a second.
Yeah, why not? Go ahead.
OK. I think monetization is coming through, but, you know, we could do a straw poll, both in the studio and also amongst the viewers. How many of us are actually paying for AI services today? Now, I'm a tech analyst. I do look around, I do play with these things or whatever. But in all honesty, I'm not paying anything at the moment because whilst there is some value add and some interest, and obviously it relates centrally to my job, I don't see on a personal level there's enough value add for what I need and what I want from these services. So first of all, I would say we're still at a very early stage in terms of the innovation and development of the products. And you look at the numbers coming through, particularly from the big tech platforms in the US, they are beginning to monetize it, but nowhere near as fast as they should be, given they're spending tens of billions of dollars on infrastructure. So I think, you know, again, potentially this year is the year of reckoning. And for some of the more peripheral players, if they're not monetizing it, can they really sustain capex investment at this very rapid rate?
Yeah, well, I guess that also takes us in a little bit to the financing for this one in particular. And how is SoftBank looking at raising this amount of money?
Yeah, well, SoftBank is an indebted company. I mean, there's no issue there. I think there is headroom on their, according to our credit analysts, on their current credit holdings, so they could potentially issue additional bonds. But I think there's maybe a more interesting question as to what would happen to their stake in ARM Holdings, which is separately listed these days. Is there a possibility that they could potentially do a part disposal on some of their holdings there to raise finance? Because clearly ARMS is a stock that's done incredibly well on the back of this AI theme.
Robert Lee, thank you so much. Instant analysis there out of our Bloomberg Intelligence team, senior analyst with us there on the initial take on the big news from this morning. Right, there's plenty more ahead, including just a deeper look into how Chinese media and Chinese analysts are actually looking at what we know so far, the certainty and perhaps more importantly, the uncertainty around these tariffs coming through potentially as it pertains to the market. Plenty more ahead. This is Bloomberg.
Time for Trending in China. It's our daily look at what's making headlines in national newspapers and grabbing attention on social media. Well, today, US-China relations, of course, once again in focus on Chinese state media. Several editorials calling for a new starting point and a positive beginning in the new presidential term. Let's bring in our China correspondent, Min Min Lo. So, Min Min, we've been talking about the relationship between US and China maybe is getting off to a better start than we could have expected. And maybe it's also being echoed, that same view in Chinese media as well.
Yeah, and I think it is an intentional move from the Chinese government that we're seeing these successive editorials over multiple days across different platforms on People's Daily, on Xinhua, Global Times. There are different versions of editorials that are just sending out the same consistent message that China really wants to have this sort of reset of relations from a fresh starting point. Xinhua, the editorial there, was very keen to highlight that trade is a cornerstone of bilateral ties, highlighting how, trade has ballooned multiple folds over the years, how trade is providing hundreds of thousands of jobs for Americans, and how there are tens of thousands of U.S. companies operating in China, and this is a mutually beneficial relationship for both sides. And Xinhua was also in particular highlighting one issue, no prizes for guessing, it's Taiwan, calling on the U.S. not to progress cautiously there and not to destroy any sort of mutual trust that they have built up so far. And Global Times as well saying that, yes, China is willing to welcome this new, confident U.S., but U.S. needs to welcome a peaceful, industrious China as well, and to abandon this zero-sum mentality, and saying that a lot of that hostility now is stemming from Washington's wrong perception of China and U.S. anxieties over its own hegemony.
What about what's being talked about on social media?
Yes, so on social media, Trump's inauguration obviously was trending. People were following it, but I didn't see many very meaningful comments there. People just saying that it's a historic day. But what is really capturing attention now is TikTok. So the hashtag Trump is continuing to threaten TikTok is trending on Chinese social media. And I saw quite a number of pretty angry comments, people saying that, this is robbery. If we have to sell TikTok, why don't you sell us 50% of Apple or Tesla or Nvidia? I'd rather, not sell this and slap on the tariffs, bring inflation back to the U.S. So people are pretty up in arms about TikTok. There are some people who are expressing some form of regret that this is happening. But of course, on Xiaohongshu, I've seen so many very welcoming messages from Chinese people welcoming these so-called TikTok refugees, and Duolingo in particular benefiting from a 200% spike in U.S.-based users who are looking to learn Chinese. Have a listen.
We do have a good number of people learning Mandarin. It is not our most popular language, but it is definitely a popular language. It's among the top 8 languages that people are learning. We did see a huge spike. It's mainly because people who are, when they thought that TikTok was going to be banned, they started trying some Chinese apps like RedNote. And as soon as they showed up, most of the things were in Chinese. So they came and wanted to learn Chinese on Duolingo because of that.
So, of course, the question now is how long these so-called refugees are going to stay on Xiaohongshu, because TikTok obviously can operate now in the U.S. for now. And I've already seen posts from U.S. users saying, unfortunately, we have to say goodbye to this platform. So it was a very rare window for both the U.S. and Chinese people to interact on the same app, because many of these Chinese social media apps, they operate on their own entire separate ecosystem from U.S. ones. So interesting turn of events that we're seeing.
Yeah, a brief, fleeting moment of geopolitical bliss amidst the harsh reality that is really that we have to contend with in our world. Min, thank you so much. Min Lo there. Just on the market side, so we talked about traditional media, social media. Now, from analysts themselves and how their reactions and how to trade this, I think just a long story short is it's a slightly positive moment right now, because you are in this sort of period where we have yet to see actually a harsher stance coming out of Donald Trump. So it is an opportunity out of Global X, certainly that is what they're talking about here. But don't go rushing to go long on China. That's the advice from U.S. Tiger Securities. In fact, this is also the advice from other brokerages out there that have come out with their views. ING, Malayan, and OCBC have talked about the softer tone may lift assets shorter term, but I think to the point that OCBC is making, at best we're sideways. The risk here is binary as far as the exchange rate goes. And again, it's a tentative relief for assets. It's certainly a window of opportunity. But again, who knows how the story evolves. We're just one headline away, really, from this being on its head.
And you're already seeing sort of that sentiment as well, because we had seen successive days of advances for mainland and Hong Kong stocks. But again, today, you're under pressure so far. And it also speaks to really what other people are saying is it's not really a story of what's happening between the US and China. It's just China also grappling with its own domestic issues. And that is also playing into what we're seeing in the property space today as well.
The issue in China.
Yes. That and consumption, I guess.
Yeah.
But Sunak, actually, this one is rising today, and you've been tracking that story, Dave, but around the creditor approval on a debt overhaul.
Yeah, they managed to secure that. At least this is really one encouraging piece of science. So in other words, this is not all bad news as far as the debt overhaul and restructuring conversations go. And, we will be finding ourselves in instances like this where we'll be talking about specifically as far as the bonds are concerned. Vanke is a case in point, right? The sentiment around this story has changed substantially day to day, hour to hour. So the story today as far as the local currency bonds are concerned, they've risen so much so quickly that they were halted this hour. I believe they should have resumed trade, but as you can see, the point we're trying to make is some of these bonds, this is really a trader's market, and people are making a lot of money. You should get in, suffice to say, the obvious here, at the right time. So bonds currently are doing well on this story. Plenty more ahead here on Bloomberg Television.